Thank you very much for another opportunity to go through what we call the seven sisters in the oil and gas sector. The seven sisters. And the outline that will follow is as one, we'll look at the definition of seven sisters. What do we mean by seven sisters? We'll look at the phases of seven sisters as they were developed from 1928. We'll look at benchmark crude and the derivative transactions. We'll also look at other crude grades and trade arrangement, and we'll conclude. So this discussion is going to be very brief, just to introduce us to what we call seven sisters, and this should motivate you to read more around seven sisters to understand the history and the development of the oil and gas sector, especially after the First World War. The seven sisters. Seven sisters basically are powerful oil and gas companies which actually met in Ankara in Scotland in 1928 and came up with the Ankara Agreement, which segmented the then known world in terms of oil and gas reserves among themselves. We call them seven sisters because these companies were seven in number. So that is why basically we call them seven sisters. The seven sisters became well known when oil became prominent after the First World War due to their role in global oil production and marketing. The seven sisters refer to seven powerful oil giants or majors at the time, such that before the 1970s, when OPEC became effective, they fully control the global oil trade and engage in long-term contracts in oil-rich developing countries. So what they did basically is to control the oil and gas industry by establishing their trading affiliate or subsidiaries, which engage in more than 70% of export of oil to their own subsidiaries or affiliates in their home economies or countries, and the rest to the downstream companies, usually refineries, which were not part of the group. So this arrangement made transfer pricing the preferred and dominant strategy for the seven sisters at the detriment to the host nations, since this deprived them of the required revenue. So what they did briefly was that because they have established subsidiaries in their home economies, they priced the oil that they produce through the long-term contract that they sign, for which they pay some minimum royalty, where the host nation receives just a minute portion of the oil in terms of revenue. The bulk of the oil is exported to their subsidiaries in their home countries at a low cost, or the price was very small. But when they refine the product and they sell, they make a lot of profit. So because it involved transferring the produce to their own companies in their home countries, using lower price to transfer that to their subsidiaries. That is where the transfer pricing comes in. And transfer pricing actually undermines revenue for host nations where the economic activity is taking place. Nowadays, transfer pricing has become a huge discussion, especially when we are discussing tax policies for nation and the global economy. And some studies have come to establish that transfer pricing is undermining revenue generation in most economies, especially developing countries where multinationals dominate and have subsidiary across the world. So that was what they were doing those days, undermine the revenue generating ability of host nations from their own resources, where they were gaining so much through the arrangement they made with their subsidiaries. So they gain a lot at the detriment of the host nations. So when we mention seven sisters, it's not merely about seven major oil companies who came together to have an agreement to segment the countries, especially in the Middle East countries that have oil reserves among themselves. It also goes to establish the fact that these companies have the ability to suppress the revenue generating abilities of host nations, thereby depriving them of the needed revenue to develop countries that have actually oil in abundance for which they were tapping into. And this behavior hasn't changed so far. There are many developing economies with this resemblance of these seven sisters operating. The agreement that they sign is such that it's not so much benefiting the countries in terms of the revenue generated from their operations. Sometimes countries will announce the volume of oil that they produce from their oil fields, but sometimes more than 70% of the oil is ceded to the IOC, that is international oil companies that operate, and they get just about 30% of the proceeds from the oil. Uh, so it means that the situation has not changed significantly, except countries that are actually operating different fiscal regimes, like the rig service contract, where arrangement where the host nations have control over their oil resources, and they only employ IOCs to come and drill or explore oil for them, and they pay them for the services rendered, as opposed to they sharing in the proceed. Uh, Apart from that, many countries who even claim that they are operating the hybrid system are not getting the best out of their oil reserves. Companies such as Exxon, Mobil, Texaco, Standard Oil, Chevron, Royal Dutch Shell, British Petroleum were all part of the Seven Sisters. And some of these companies today have transformed into new entities which are still operating in the industry. The Seven Sisters we talk about, they operate in such a way that the form within which they operated could be classified into phases. So we have phase 1, phase 2, phase 3. Phase 1 of the development of the Seven Sisters actually started from 1928 to 1947, where the Seven Sisters started operating way back before the formation of an effective OPEC in the 1970s. Actually, OPEC was formed in 1963, but its effectiveness was actually seen in the 1970s. While their empires and governments colonized other countries, these companies monopolized production of natural resources, especially black gold. Black gold, we are referring to oil, by segmenting the market outside the United States of America among themselves. So all the areas of the world where outside the US that we have oil in commercial quantity, oil reserves in commercial quantities, they segmented it among themselves. So it's just like their home countries, which colonize a lot of countries across the world, including the Middle East countries. They were using their economic power to actually monopolize production in those countries. So you go here, you focus here, that kind of thing, just like those who came to colonize us did. But they were minded not to implement the agreement they signed in the US because of antitrust laws, which were protecting competition in the United States. So they couldn't have used that in the United States because those antitrust laws were put in place to protect small oil and gas companies. So if you introduce that there, it means that you will defeat the purpose of that law. So that is why they were undertaking this outside the United States of America. In the phase one, they were using what we call single pricing formula, what you call the GAF plus freight to compute the FOB oil price. They were using the nearest port to determine the FOB price. So the Gulf of Mexico was used at that time. So that's why we have the Gulf Plus fleet to compute the FOB price. The actual agreement which put these 7 companies together was signed among them at Anchorage in Scotland in 1928. The agreement permitted those oil majors or companies to fix oil prices based on high oil prices in the US to make excessive profit because they produce at lower cost from the oil reserves in the Middle East countries. They were not to implement the agreement in the United States because that would violate the existing antitrust laws which protected small oil companies to operate marginal cost plus approach. So the small oil companies were actually using the marginal cost plus approach, but the 7 sisters were using the Gulf plus fleet approach to compute the FOB price. So there were 2 price regimes, those operating in the US and those operating outside the US. It can be concluded that the Anchorage Agreement was signed to protect the interests of both the majors and small oil companies. So while the agreement benefited the the 7 sisters, the agreement was not allowed to operate in the US. So it means that the agreement doesn't have the ability to influence the small oil companies in the US. So the small oil companies were protected because the agreement will not affect them, and the majors were also protected to continue to make their huge profit outside the United States. So all these things should tell us that when businesses are set up, especially the multinationals, you may receive some good benefit, some benefit from them. They will transfer technology. They will bring about efficiency of production. They will actually employ people from the home country. They will help you to modernize your economy, generate revenue, and the rest. But their aim is not to come and serve as a Father Christmas. You will need to take your destiny of your natural resources into your own hands. If you don't do that, there is no way you are going to get a mutually beneficial agreement. Because when you go to enter into an agreement, even though there is a fair play, but the point is that somebody will come to the table with greater strength, and that greater strength may influence a lot of things that you will accept. And that is the reason why, even though many countries in Africa producing oil have entered into an agreement with oil companies, but we realize that those agreements are actually more beneficial to the investors into our oil and gas sectors. So phase two started from 1947 to 1971 thereabout, where oil and gas literature indicate that wars, especially World War One and Two, played important role in investing in more exploration and production. During the Second World War, the operations of the American and British navies forced or encouraged the Seven Sisters to review the Gulf of Mexico pricing formula to nullify the effect of fleet costs of the distance between Gulf of Mexico and Abadan, as suggested by the British and American government. So during that period, they were looking at the distance which affected the cost of uh, conveying the crude that they produce from one point to the other, and they have to actually abolish by the advice of the British and American navies, which are working together to benefit their companies. The review introduced two base oil pricing formula, which made Persian Gulf second base for oil pricing formula. So what it means is that depending on the destination of the oil that they are exporting from the host countries where they have control over, the closer terminal that they want to use will determine the pricing for the destination. So if where they are sending the oil to is closer to Mexico, then they will use the Gulf of Mexico pricing formula. And if it's closer to the Persian Gulf, then the Persian Gulf formula will be used. So the new approach led to some reduction in the profits of these IOCs. During the first and second phase of the Seven Sisters, they behaved like oligopolists and unilaterally set free on board prices for buyers and also set the CIF selling prices. Now, this should tell us why oil and gas sector have become heavily regulated even in developing countries, because if you don't put in place robust regulation that regulate every aspect of the industry, you will realize that these oil companies, which bring huge investment in millions of dollars, will have control and have everything that they want in the agreement that will benefit them. And that is why in Ghana we have the Petroleum Commissions Act regulating how Petroleum Commission to help to regulate the upstream. We have the Petroleum Act at 919 of 2016 that even tells you how to actually give out petroleum fuels to people. It might be given in blocks. You must announce that there should be competitive bidding. Even when there will not be any competitive bidding, there might be reasons agreeable or in consonance with the requirement of the law. The law provides what percentage the state will have as an interest. We call carried interest. That is minimum of 15% now in section 10 of the Petroleum Act. It is because of all these lessons that some of these fees regulations were put in place in order to guide the industry. Because if you leave it like that, people, investors with stronger ability to negotiate will negotiate the state out of the benefits of the oil and gas sector. So the West Texas Intermediate, the WTI, and Arabian Light crude were the main benchmark crudes trading in physical market rather than derivative market. So at phase 2, derivative market was not a predominant activity. Derivative transaction was actually not transaction were not predominant in this phase. They were actually basing their transactions on the physical market transaction. So the FOB buying prices were enshrined in the then concession agreement with the host nations. I believe you can recall your understanding of concession, as we discussed in our earlier interactions. We discussed concession, and we discussed petroleum agreement in general. We discussed various forms of fiscal regimes, including concession, production sharing agreement. We talk about risk service agreement, etc. So I believe you can recall all those things. So we also have tanker services, uh, logistics and haulage industry actually play key role in the marketing of crude oil and its derivative products. And today we generally call these as the support services to the oil and gas sector. If you are producing from the upstream, you will need logistics and the haulage subsector to support it, because a vessel will have to transport the crude from the FPSO or the production unit to the marketplace, which is far away from the field. So you see that the transport subsector is very key. Logistics is key. Supply chain is key. Procurement is key. Support service to the oil and gas sector. Both are the upstream, the midstream, and the downstream, where the marketing actually takes place. So that will be the end of the phase two. So the phase two, the critical thing in phase two is that we have two base formulae that is used depending on the destination of export. And then we also saw that it affected slightly the profit of the Seven Sisters. And we also saw the beginning of the conception of the derivative transaction, because largely it was a physical market base, and the logistics subsector, the transport sector, the haulage sector was very key to the marketing of oil within that phase. The phase three, that the third phase, spanned from 1971 to 1986, with 1973 and 74 reporting major crude oil price escalation or crude oil crisis. So in 1973 especially, there was collapse of crude oil prices, and that affected a lot of countries that depended on oil. As we are seeing today, where coronavirus and then other development in the geopolitics of oil producing countries like Saudi Arabia and Russia actually led to collapse of prices. If you take the peculiar case of Ghana, Ghana expected about $58 per barrel enshrined in the budget for 2020, expected some amount of revenue from petroleum receipt, but all of a sudden within the first quarter, because of corona and other development, price has collapsed to around $29 per barrel, which means that Ghana is already losing more than 50% of expected revenue from crude oil. That will actually negatively affect implementation of the budget and project and programs activities within the budget. In 2014-2015, Ghana estimated about $193.06 per barrel, but within a short period of time, that price collapsed to around 28 and actually moved gradually to around $40 per barrel. So that also affected Ghana, not only in terms of implementation of the budget, but it also affected the position of foreign exchange development, and that brought about huge depreciation, which affected pricing in the country. So that was the situation in the 1973, and price started recovering from 1974. So even though OPEC was established in 1963, it was until 1970s that it became very effective in controlling domestic upstream output and determining prices. So it was in the 70s that the OPEC member became strong, and they were actually dictating the pace of supply to the market, controlling prices, and making gains from their member countries. Um, it is also to be noted that OPEC became very, very strong during that period because most of their leading countries in OPEC became uh, were able to nationalize their oil fields, which means that they were able to collect back those oil fields to their countries under the national oil companies, and that they were actually, most of them were engaged in service contract or service agreement, which actually allowed them to have full control of the oil. For example, Ghana is producing oil, but if we produce about 200,000 barrels, that 200,000 barrels do not belong to us. We may get maximum of about 25 to 30%. The rest belong to the IOC, the investors, the, who have a resemblance of the Seven Sisters. They are taking a chunk of it. But if you're having control over the resources, you can actually be active in determining how much you put on the market and at what price it should be sold. So that is when OPEC became very strong. In order to manage the fall of the Seven Sisters to benefit oil producing members, there was increased nationalization of upstream assets of the Seven Sisters, who were mainly the international oil companies. Yeah, having talked about the benefit of nationalization for OPEC members, and uh, that actually set in motion a new dimension to oil pricing and production and supply. It is important to indicate that in most countries, especially developing countries, nationalization of private assets of investors' assets are actually inimical to the law. It is not allowed. If you read Article 20 of the 1992 Constitution of Ghana, it allows for individuals to actually freely establish businesses, own asset, property, etc. And the state is not supposed to voluntarily take or compulsorily take those assets from them, not even from foreigners. However, we also need to indicate that there are processes by which nationalization can take place if it is in the interest of if it is in the public interest, is the interest of national security, etc. So there are very limited reasons for which nationalization can take place in line with the constitution, without which it is generally not acceptable to promote nationalization. Of course, with coronavirus, we have heard from some countries which are nationalizing private hospitals and health facilities, especially in Europe. Spain is one of them. I don't know of their laws, but until the coronavirus, which is a national, global pandemic, which actually threaten life and safety, they wouldn't have nationalized. So you could see that they are doing the nationalization based on public interest uh, uh, reasons. So nationalization is not just a tool available for state to just go in and do. The move was fortified with the creation of national oil companies to manage upstream domestic production, sale, and pricing. So, what the nationalization did for these oil rich countries is to fortify their NOCs, that's their national oil companies, because it was the national oil company that took over those oil production units and began to produce. And as they were producing, they were not supposed to be paying royalty to any other person. They were actually producing for their nation, They were supposed to determine how much they want to put on the market. They were supposed to determine how they want to sell it, whether they want to refine the product before they sell it or they want to sell it in raw form, and how pricing should be done. At the initial part of the third phase, the formula and long-term contract used in the earlier phases, as discussed earlier, were operating side by side with the world crude oil price set by OPEC. Spot market transactions became operational and OPEC started using spot quotations as reference point for its official selling price. It is important to note that spot market delivery in the industry could range between 15 days and 30 days. Yeah, spot market is the immediate market, is the cash market, is the immediate exchange for goods or for the commodity. But because oil is such that it is stored in at a point and it is transported to the destination or where the buyer is. When we're talking about spot market here in the oil industry, especially for unrefined product, it does not necessarily mean immediate as in the word immediate. That immediate could be defined in the oil and gas industry to span from 15 days to 30 days, because you will need to transport or get to the point of delivery as will be put in the agreement. The Arabian Light and West Texas Intermediate (WTI) were the main crude markers or benchmark crudes, with physical market together with spot price transactions in those days. After the 1986, competition was noticeable at all segments of the oil and gas value chain. Slow growth in demand pattern, long-term contract spot transactions, and exchange trade crude form part of the oil and gas market. What it means is that gradually the market is developing itself into a derivative transaction base, where you can actually enter into a contract and the delivery will take place at a future date, though the price is actually determined at the present time. Oil is now traded as financial derivatives, dominating international oil and gas pricing. This kind of transaction is described by some as paper oil, paper barrel, or financialization of oil. So today, when we are hearing of quotation of international oil prices, naturally it is a future price, the futures. So futures is a type of derivative. So you can see how derivatives have now become part and parcel of the international crude market architecture. This kind of transaction is described by some as paper oil, as I indicated earlier, and in managing oil and gas revenue and debt, swap futures and options are used. So we use swaps to manage differences in maturity of debt and then nature of interest rate, whether it is fixed or variable interest rates. Then we also use futures and options to actually manage the purchasing and sale of crude oil nowadays. So somebody can take a long position being the buyer, and another will take a short position being the seller in derivative transaction. But the key thing is that some of these transactions are traded on the stock exchange, such as the futures and options are traded on the stock exchange. So that is the development during the Seven Sisters. While a reactive shortage of petroleum product and price volatility are managed by using tools of hedging, such as short-term forward contracts. So even price volatility and product volatility are also managed using derivative instruments such as futures, options, and the rest. In fact, forward contract is part of derivative, but is the most basic form of derivative transaction. So when we're talking about hedging as we use, it's just a matter of using one of the derivative strategies to benefit us depending on our position, whether we are short position trader being the seller or we are long position trader being the buyer. So we use a particular strategy to ensure that our interest is protected. We have benchmark crude that have been developed with so many countries having their own crude types, but it is not clear the number of crude oil grade in the world today. But it is certain that there are there are more than 125 crude grades in the world. Benchmark crude is a reference grade for crude oil of similar qualities and locations. Generally, crude oil with low sulfur content of less than 0.5% is described as sweet, and the one with high sulfur content of more than 1.5% is called sour. With respect to crude oil gravity, American Petroleum Institute API standard is the one used to check the heaviness or lightness of crude. So, heavy crude is therefore under 20 degrees API, and light crude is above 33. The crude grade affect refinery operations and the number of products that a certain volume may produce, and ultimately affect price. So if you are taking light sweet crude, for example, the price is higher than the heavy crude, heavy sour crude, and when it is refined, it comes out with so many derivative products, which we call the gross product worth. So the gross product worth of light sweet crude is higher than the gross product worth of a heavy sour crude, because the breaking down of the hydrocarbon molecules are actually easier when it comes to light sweet crude than the heavy crude. And the heavy crude normally is used for the production of or generation of power, etc. But crudes have many derivative products. In fact, some writers say it has more than 600 derivative products. We can mention things like bitumen for the road construction industry. We can talk about its integration into agriculture by producing fertilizer and the rest. Most plastic industry use byproduct from oil and gas, etc. So we have a lot of derivative products that makes crude a very important commodity in the world market. Brent crude and WTI, which are traded on the spot market and the derivative market in general, have overtaken Arabian light, which is the name of the product or crude oil produced in Saudi Arabia, with 5 million barrel volume production as the benchmark crude in setting OPEC official price in early 1980s. So major characteristics of benchmark crude. For us to classify a type of crude as benchmark, that would guide price formulation in the market. First, that crude must have these characteristics. One, security of delivery. There must be security of production and supply to qualify as benchmark. Is it possible that this type of crude will be produced for a long period, or is a crude whose reserve is just short term? So we need to see the security of supply. Will it be for over a long period of time, or that type of crude will vanish from the reserve base of a short period of time? Then different types of sellers and wide acceptance by consumers. So it might not be a type of crude which only few people are consuming, which means the demand will be low, and that will affect production downwards, with time. So that's why you need to look at the portfolio of consumers for that type of crude. And when consumers are many and markets are accepting that type of crude, then it can be used as a benchmark crude. So this is to ensure that the market has some form of competition. Consumers include different refineries and power producers are able to use it. Large market acceptance should be an important characteristic. Risk management tools. Many traders and hedgers may use the grade as risk management tools. They can actually keep their wealth in that commodity over a period of time as an underlying asset for risk management purposes, because normally such grades are used as pricing mechanism for related products. Other crude types or grades. Other crude grades, they have very interesting names. Very interesting name, and I will expect you to research and have more names for crudes produced by different countries which are not listed here. We have Bonny Light, that is the type of crude in Nigeria. We have Urals, that's from Russia. We have Arabian Light, that is Saudi Arabia. We have Tepis, that's Malaysia. And we have Minas, that is Indonesia. Sahara Blend, that is Algeria, among others. Ghana has not given any name yet. That is why we don't have it here. So we have different types of trading arrangement in crude, including barter trade. Barter trade is supposed to be the most primitive trading arrangement, but at the time when oil producing nations were people in were not very conversant in heavy technology and infrastructure development, it was appropriate to use barter trade. Of course, barter trade itself has its own challenges, double coincidence of wants. So you must have people who are interested in the type of crude you have, and you must also be interested in the product they have to exchange. Some of these things can create a challenge for trading, but that was the most basic form of trade arrangement when oil became a commodity to trade in. Even oil for food arrangement after the Iraqi invasion is a replica of barter trade or deal. In the Middle East, petroleum products and crude oil was exchanged for finances, goods, and services. Some use it to acquire industrial tools, power generating equipment, and in some cases, refined products. So, barter, though, is considered to be one of the most primitive forms of trade arrangement. It was useful at the time because of not having the level of technology and market infrastructure we have today. The kind of financial system we have today was not in existence. The kind of communication system we have was not in existence. So barter trade was very helpful for them to acquire some industrial tools, power generating machines, and even in terms of refined product for their industries. So I want to pause here. Now we have many other trading arrangements as I mentioned earlier on, but I just want to emphasize on why barter trade was important then and how useful it was then. I will now pause for your questions. Yeah, actually, OPEC was not in existence before 1963. OPEC came into being in 1963. So what it means is that, and OPEC was in a reaction to the, if you like, um, the cheat, the suppression that the host nations were going through under the Seven Sisters. Because, as I explained, what was the agreement in 1920? Basically, to segment the then oil and gas reserves of the world, especially in the Middle East. So, just like colonialism, that some people came to Southern Africa, some people went to Northern Africa, some people went to Central Africa, and there are different countries. Portuguese here and there, British there, the French also went uh, their way, the Portuguese, the Spanish, etc. So it was the same way, but the intention was not to help those countries maximize or optimize benefit from their own natural resources. So OPEC was actually formed as a reaction to this kind of disservice that they were doing to them. So that was the reason why when OPEC came into being, you saw that they came with nationalization. So we are taking back our own resources. We want to be in charge of our own resources. So that was the situation. Yes. Yeah, if you look at the phase one and phase two, we are using the term they have firm control. So these seven sisters, they have firm control wherever they are, just like colonialism. When they came to various countries that they colonized, in fact, even the basic structure of governance in those countries were taken away. So they brought in their own governance structure. So they were in charge. So they are more or less like the owners of the resource. So they were just giving I mean something small to the host nations. So they pay royalty, and the royalties are based on the long-term contract price, which were said to be very low. Okay, which were said to be very low. But when they send it to their home countries, that's when they price it higher, and they refine it, and then the market share is so high, they make benefit from it. You see, so it's like they are buying the oil at a cheaper price from the host country and selling it in the other set of economies at a higher price. So they were benefiting from the transfer pricing. See, but they also had control. So the host nation at that time didn't have the power to stop them. So it was when some of them became aggressive, especially in the late 1950s. The late 1950s, most of these countries, Venezuela, Libya, Iraq, Iran, all those countries, they wanted to take hold of their own resources. And that was when the formation of OPEC was very important, so that they work as a unified force, not like individual countries fighting these seven sisters, which of course actually had a lot of resources. In fact, if we put the asset of these seven sisters together, so in fact, sometimes one oil company, their asset put together is about 5 times more than the GDP of some of these countries in those days. So they were actually very powerful in terms of resources. So that is how. So, but when you come to transfer pricing, it's something that should be fought with regulation in the domestic country. So that is why you see people who are interested in tax justice are also supporting host nations or countries to fight against transfer pricing. And of course, transfer pricing is not only in natural resource sector, it's actually in other sectors within the economy. So we need to come up with strong regulation Enforcement should be very clear, and we should be able to put in place some indicator that can trigger the presence of transfer pricing for us to punish those multinationals that involve in it, to the detriment of the revenue generating expectation of the host nation. Yeah. Okay. So thank you very much.